So you've built an incredible business, and that first letter of intent, it finally lands on your desk. Man, it feels like you've just scored the winning touchdown, right? Well, here's a reality check. You haven't won the game yet. You've just made it to the Super Bowl. These next 90 days, that's where deals are won or lost. Today, we're going to break down the playbook you need to quarterback your own exit and lead your team to a win. Let's dive in.
Okay, this is probably the single biggest mindset shift any founder needs to make. That letter of intent, the LOI, it's not the trophy. It's just your ticket to the main event. And that price, those terms, they're really just a suggestion. For the next 2 to 3 months, the buyer's entire team, their accountants, their lawyers, they're all dedicated to one thing: poking holes in your business to try and justify a lower price. They call it diligence, and it's where all your preparation either pays off big time or completely falls apart.
Honestly, you should think of this whole period as an intense 90-day gauntlet. For that first month, the buyer's team is just kind of getting organized. But then the scrutiny really deepens. By day 60, they've dug in. And if there are any real issues, the kind that lead to a price cut or a totally broken deal, they've probably surfaced by then. This entire process is literally designed to put every single part of your company under a microscope.
And this, right here, is the million-dollar question. You're getting buried under hundreds of document requests, late-night questions from the buyer, but here's the catch. You still have a business to run. The second your sales dip, or a key employee gets nervous and decides to leave, or your performance just falters in any way, you are basically handing the buyer a loaded gun to renegotiate the price. So how in the world do you fight a war on two fronts without losing ground?
The answer? You stop playing defense and you start playing offense. Look, the leverage you have in a deal isn't created during the negotiation, it's forged in the weeks and months before you even go to market. This is all about preparing your answers before the questions are even asked. It compresses the timeline and protects your valuation from those last-minute 11th-hour attacks.
And that's why every single deal needs a deal quarterback. This role, and it's often filled by an M&A advisor, is your shield. They become the single point of contact for every buyer request. Their job is to filter all the noise, manage the flow of data, and absorb all that task traffic, which frees you up to do the one thing that protects your valuation the most: run your business and hit your numbers.
So here it is, your pre-game plan. 3 tasks that are absolutely non-negotiable. First, set up a virtual data room. Think of it as your secure, super organized library for all your company documents. Second, commission a sell-side quality of earnings report. This is huge. It's like you're hiring a top accounting firm to audit your own books to find and fix any issues before the buyer does. And third, draft what's called a working capital peg to clearly define the cash you need to run the business. It prevents so many last-minute arguments. Get these 3 right, and you control the game.
And this is the whole point. Without prep, the buyer is on a treasure hunt for problems, and you're just stuck in a constant state of putting out fires. But when you do the work up front, their whole job changes. They're not investigators anymore, they're just verifiers. They're simply confirming the story that you've already told and meticulously documented. This shifts their mindset from skepticism to confidence, which is exactly where you want them.
All right, so we've got our offensive strategy set. Now it's time to anticipate the defense. There are a few specific high-stakes areas where almost every buyer is going to apply pressure. Let's walk through how to prepare for them, so there are absolutely no surprises.
Okay, first up, let's talk money. A buyer isn't just going to glance at your tax returns and cut a check. No way. They are going to rebuild your financials from the ground up. What they're trying to find is the true, repeatable cash flow of the business. You'll hear the term EBITDA a lot. That's earnings before interest, taxes, depreciation, and amortization. But just think of it as the core profitability of your company, with all the unusual or one-off expenses stripped out.
Now, this is where you get to increase that core profitability by documenting what are called add-backs. These are totally legitimate business expenses that a new owner won't have to deal with, like a one-time software upgrade or, say, the part of your salary that's way above the market rate. But you can't just claim them. You have to prove them with contracts, with invoices, with bank statements. A clean, well-supported add-back schedule is one of the fastest ways to build buyer trust and, of course, maximize your value.
Next up is customer concentration. Take a look at this chart. If any single customer makes up more than, say, 15 or 20% of your revenue, buyers see a giant red flag. They are terrified that if that one customer leaves after the deal closes, the value of the business they just bought is going to plummet overnight.
The good news is, you can play offense here too. The single best way to diffuse this issue
Get that major customer to sign a multi-year contract renewal before the deal closes. If that's just not possible, you could propose an earnout, where a chunk of your payout is tied to keeping that client. And backing all of that up with a strong sales pipeline and hard data showing low customer churn also goes a long, long way to calming those buyer nerves.
Now, every state has its own regulatory quirks, but some, like California, well, they have hurdles that can completely derail a deal if you're not ready. Buyers bring a microscope to these states because the financial risks are just huge. We're going to use California as our main example here, but the principle is universal. You have to know your local battleground and be prepared for it.
Just look at this slide. It really tells the story. On the left, you've got standard HR diligence. Pretty simple stuff. On the right, you've got the California gauntlet. Buyers there won't just ask for an employee list. They're going to demand proof that your contractors aren't misclassified employees under the infamous ABC test. They're going to audit your meal break logs, and they will hunt for any exposure under PGAGA, a law that lets employees sue on behalf of the state, leading to massive potential penalties. In this environment, HR isn't just paperwork, it is a major, major risk area.
And if your business owns or operates from any kind of commercial or industrial property, you can bet environmental diligence is coming. Step 1 is a Phase 1 environmental site assessment. It's a report that identifies any potential contamination risks, but the key here is to commission this yourself and do it early. That way you find any issues first, and you can propose solutions like a repair or a specific escrow before the buyer can use it as a late-game negotiating tactic.
So we've covered the what of preparation. Now let's talk about the how. Specifically, how you manage the live deal process to control the pace of the conversation and, maybe most importantly, to protect your own time and sanity so you can keep driving your business forward.
And make no mistake about it, founder burnout during diligence is a real and present danger. You're trying to close the most significant transaction of your entire life while you're also trying to hit your quarterly targets. I mean, the relentless flood of questions can be completely overwhelming, and if you get exhausted and take your eye off the ball, both the business and the deal are at risk.
This is where your virtual data room transforms from a simple file cabinet into your strategic command center. When it's organized logically, with folders that actually anticipate a buyer's request list, it becomes the single source of truth for the entire deal. And it lets you control exactly who sees what and when.
This slide shows the difference between chaos and control. The key is to enforce one simple rule. All communication flows through a centralized Q&A log in that data room. No side emails, no one-off phone calls. Every single buyer question is logged, it's assigned to the right person on your team, and it's answered officially. This creates a perfect audit trail. It prevents your CFO and COO from accidentally giving different answers to the same question, and it allows your deal quarterback to shield you from 90% of the noise. You get preserved for just the big strategic decisions.
So let's tie all of this together. This level of preparation, it's not just about being tidy. It is about creating a decisive, almost unfair advantage in the sale process. It's what separates a clean, on-time close at your target price from a deal that gets bogged down in delays and last-minute drama.
I mean, this chart really says it all, doesn't it? The unprepared seller is incredibly vulnerable to what's called a price chip. That's when a buyer finds an issue, or even just the perception of an issue, late in the game and uses it as leverage to demand a price cut. When you were this prepared, you essentially remove that ammunition from their arsenal.
At the end of the day, all of this really just boils down to trust. When a buyer enters a well-organized data room and gets prompt, complete answers to their questions, it builds a tremendous amount of confidence. They see you not just as the founder of a great company, but as a credible, professional operator, and that trust, that is your best defense against them trying to retrade the deal right at the goal line.
You know, this quote right here is really the core takeaway. A successful exit is almost never a matter of luck. It's a direct result of the discipline you apply to the process long before a buyer is even at the table. Preparing early, documenting everything cleanly, and controlling the flow of information, those are the pillars of maximizing your outcome.
And so I'll leave you with this final thought. There is a huge difference between deciding to sell your business one day and building a business that is always sellable. By embracing these principles of preparation and control, you're not just getting ready for one transaction. You're building lasting, transferable value into your company. And really, that's the ultimate goal.